So, is a recession coming in 2026? That's the question on everyone's mind right now, and for good reason. For every single warning sign that's flashing red, there's this incredibly powerful engine of growth that just keeps pushing forward. In this explainer, we're going to cut through all that noise. We'll look at the conflicting forces at play and, most importantly, lay out what it all could mean for you. Let's dive in. Let's just start with one number, 35%. That's the probability that analysts at JP Morgan are giving a US recession in 2026. Now, that's not exactly a coin flip, but it's definitely high enough to make you sit up and pay attention. It just perfectly captures the uncertainty we're all feeling. So why isn't that number higher? Or for that matter, lower? Well, that's where things really start to get interesting. This quote from JP Morgan's head of global market strategy really nails it. The economy isn't just sending mixed signals, it's going through what he calls a multi-dimensional polarization. You can think of it like this. The economy is literally being pulled in opposite directions at the same time. On one side, you've got incredible strength, and on the other, some very real weakness. So let's break down each side of that tug-of-war, starting with the case for a downturn. So what are the red flags that have economists so worried? Well, it really boils down to two big things that keep popping up: a job market that's cooling off and costs that just refuse to come down. First up, let's talk about jobs. For what feels like years, the story was all about a red-hot labor market. But that's changing. Economists are now seeing a clear, persistent slowdown. In fact, Charles Schwab's latest outlook points to this as the main reason the Fed is even thinking about easing up on interest rates. And you can really see this trend playing out in the data from the Philadelphia Fed survey of professional forecasters. Look at this. They've had to slash their expectations. For 2026, they went from expecting over 86,000 new jobs a month all the way down to just 55,000. I mean, that is a huge drop, and it's a crystal clear signal that the job creation engine is losing some serious steam. But a slowing job market, that's not the only storm cloud on the horizon. The other major worry is that costs for both businesses and for us as consumers are staying stubbornly high. And you can thank persistent inflation and some new friction in global trade for that. Right, so we all know inflation is still hanging out above the Fed's 2% target, and new tariffs are just adding more fuel to that fire. For manufacturers, this uncertainty is their number one headache. A whopping 78% of them are bracing for their own cost to jump by over 5%. And those pressures, they eventually squeeze everybody, from the factory floor all the way to the checkout line, and that acts like a powerful brake on the entire economy. Okay, so that's the doom and gloom case. But remember that 35% number. It's not 80%, right? And that's because there are some incredibly powerful forces pushing for growth. So let's flip the script and turn to the other side of the argument, the case for economic resilience. This single biggest tailwind for the US economy right now, bar none, is the historic, almost unbelievable boom in technology and AI-related investment. And this isn't just some niche tech story. This thing is a monster, and it's fueling growth across the entire economy. Get this, JP Morgan figures this AI supercycle is responsible for up to 15% of earnings growth for the S&P 500. And we're not just talking about tech stocks here. This is a fundamental rewiring of the economy's engine. It's creating whole new industries. Startups for small nuclear reactors to power all these data centers saw a 10-fold increase in funding last year alone. And government policy is fanning the flames. The One Big Beautiful Bill Act lets companies immediately write off new equipment costs, which is a massive incentive to just keep spending and building. All right, the second pillar of strength is you, me, the American consumer. Despite inflation, despite high interest rates, people have, for the most part, just kept on spending. And that has propped up the economy in a way that, frankly, a lot of experts did not expect. So why are consumers holding up so well? Well, JP Morgan points to a widening divide. You've got wealthier households who drive a huge chunk of spending, and they're feeling pretty good thanks to gains in the stock market and rising home values. Retiring baby boomers are also spending with a lot of confidence. And yeah, while the labor market is slowing down, an unemployment rate of 4.4% is still pretty low by historical standards. That gives a lot of people the confidence to keep their wallets open. So we have this really clear economic tug-of-war. But layered on top of all of it are a few major wildcards that could just tip the scales dramatically one way or the other. These are the great unknowns for 2026. If you want to see this uncertainty in action, just look at oil prices. You've got two of the world's leading energy authorities, the IEA and OPEC, looking at the exact same data and coming to totally opposite conclusions. The IEA sees a huge supply glut that could cause prices to tumble, which, by the way, would be great for inflation. Meanwhile, OPEC sees a totally balanced market. Who's right will have a huge impact on the economy. And the other huge wild card? It's political. Federal Reserve Chair Jerome Powell's term is up in May of 2026. A change in leadership at the world's most powerful central bank could mean a radical, and I mean radical, shift in policy. And this isn't some distant what-if scenario. Prediction markets are taking it very, very seriously. This chart from Polymarket shows the betting odds for Kevin Hassett, a former chairman of the Council of Economic Advisors, have surged to over 70%. So what would a Chairman Hassett actually mean for policy? Well, he has not been shy about his intentions. In a recent statement, Hassett said he would, and I'm quoting here, cut interest rates immediately. A move like that would be a complete 180 from the Fed's current higher-for-longer strategy. It would send shockwaves through the markets, sure, likely boosting growth in the short term, but also risking a really dangerous return of inflation. Okay, so that's the landscape. A polarized economy with massive wildcards on the horizon. This all leads to the critical question: how in the world do you navigate it? So let's turn to the experts and look at their investor playbook. Now, before we dive into strategy, it's really important to understand the base case. That's just the fancy term for the most probable outcome that experts are planning around. According to Charles Schwab, the most likely scenario for 2026 isn't a crash and it isn't a boom. It's a middle path: steady, moderate growth, inflation that cools but stays a little sticky, and the Fed managing maybe 2 or 3 more rate cuts. So with that base case in mind, analysts at Charles Schwab are suggesting a 3-pronged strategy. First, take a fresh look at your bonds. Because rate cuts are expected, intermediate-term bonds, think 5 to 10 years out, could be a real sweet spot, letting you lock in today's higher yields before they start to fall. Second, to guard against that sticky inflation we talked about, consider Treasury inflation-protected securities, or TIPS. They're designed to do exactly what their name says. And finally, if you happen to be in a higher tax bracket, municipal bonds can offer some really valuable tax advantages along with a lot of stability. So, after weighing all the evidence, from the clear warning signs to those powerful growth engines, what's the final word on the 2026 economy? Well, it brings us right back to where we started: a split personality. This is a perfect picture of that economic tug-of-war. On one side of the rope, you have the recessionary pressures pulling: a weakening labor market, sticky inflation, trade uncertainty. And pulling on the other side are the powerful forces for growth: the AI boom, a surprisingly resilient consumer, and the potential for the Fed to start cutting rates. And honestly, this is the most important thing to understand. The outlook for 2026 is so uncertain precisely because the arguments for both a recession and for continued resilience are just so compelling. The economy is truly, truly balanced on a knife's edge. Which brings us to our final question. The AI boom is arguably the single most powerful economic force in the world right now. So will it be the tailwind that's strong enough to pull the entire economy through all these headwinds? Or is it a massive bubble and its eventual pop could be the very thing that pushes us over the edge into a downturn? The answer to that question may well determine where we're all standing a year from now.